What's up, superstars? Back with another video. You got Superstar Rob and you got Superstar Nation. How you guys doing? Oh, man, beating me up every single day. If you haven't already, don't forget, become a superstar. Smash the subscribe button. Join the Superstar fam. Hit the bell notification button to get every single video every single day. And thank you so much to our VIPs for your support. $2.99 a month. You get the star beside your name in the comments. Access to our spreadsheets, giveaways, guys. Thank you so much for your support. You can always reach out to us on X, Instagram, or Discord. Guys, join the Discord. The Discord is the place to be to have these conversations. And remember, there is a security challenge ongoing right now, thanks to Rich. If you guys join the Discord, go to the security chat, and there's more information there. Just come into the Discord, say, @Superstar Rob, let me know where to find the security challenge, and we will point you into the right direction. Of course, let's get to tier 3. Right now, you have over 11 entries. We want to get over 26 entries so we get more prizes. So make sure you guys join. All right. So today, I want to talk a little bit. I'm going to get a little bit off topic here from NFT world, which we commonly cover on this channel. Today, we're going to talk a little bit about the stock market. It's the big news today everywhere that the Dow closes down 1,000 points. And then it actually closed earlier at the end of last week as well. And a lot of people are talking about recession right now. People are talking about the status of the economy and how things will go going forward. And, you know, these things happen all the time. Market cycles are common. Recessions themselves are common, and they happen from time to time if you look over the decades. So it begs the question, like, what do you do in this situation? I thought this would be a great time for me to explain my thought process on how I personally use data to help make better decisions with my investment approach. Now, this is not financial advice. It's intended to help make you think outside the box, perhaps from what you do, and just to give you ideas on other strategies that exist in the world. Because early in my investing career, I wasn't really a strategy-minded individual. As time went on and I was exposed to professionals in the investment world, I learned that many of these guys do not solely rely on fundamental analysis. They tend to use strategies that they've back tested, that they've learned and studied, and they get ideas of their rate of success over the long run. And that's why today I'm going to talk a little bit about my thoughts on terms of what I do in these turbulent times in the market. So we're going to hone in on one strategy, but this strategy is something that's backed by a book that I really love. It's called What Works on Wall Street by Sean O'Shaughnessy. You guys should definitely check it out here. I should say James O'Shaughnessy. Okay, What Works on Wall Street, and he basically built this book. And it's if you love data, it's a dream, because the book goes over hundreds of strategies and theories, and ultimately it backtests it. So to put it as like a simple, does price to book ratio really matter? Does price to book ratio really work? And he would actually go in here and he will filter what he calls decile, so the top 10% of stocks with the lowest price to book values, let's say, or the highest price to book values. And then he does a back test, and he says, okay, if I bought these 10% of stocks in the market and I back tested over time, what was my performance? So it's quantitative investing, if you ever heard the term before. And ultimately, he has some conclusions. And using data, he literally proves that the stock market is not random, right? Using data, he proves that the stock market is not just this random walk and you just got to get lucky. Over time, there is a method to the madness. And there's certain strategies that he says over time have worked. And the most basic one, which I'm going to go over today during these time periods, is consistent dollar cost averaging of all stocks. In other words, market ETFs, broad market ETFs. Back when this book was written, it was 2009 or 2011. I'm not sure how popular ETFs were at that time, or if they really even existed. Really, you had to do mutual funds with high fees. But now we have these broad market ETFs that can pretty much replicate a market for us. And if you are somebody who's in that growth phase, who's investing for the long run, turbulent times with market dips is actually a fantastic time to buy more. This is the time when, you're buying, let's say, every 2 weeks, you're buying every month, you just have these reoccurring, consistent purchasing dollar cost averaging approach. When the market dips, you're buying. And you're staying invested in a strategy which simply just holds the market. And what we've learned from this book, he did a test, is that even if you do a rolling 10-year period of the worst stock market returns back from 1926, you can go and pick the worst 10 years of any time. The following 10 years, it always bounced back and did better. And this was proven by data, right? This is what this book concludes. So when you're investing for the long run and you're ignoring these short kind of, dips, think about the pandemic, how crazy it was when that happened. People were selling like crazy. But those who were following a consistent 2-week purchasing, staying in their strategy, because this strategy of dollar cost averaging does not involve timing the market. Those are other strategies that you could back test. And if they work and are effective and have good base rates, and base rates are your probability of success, you can do that strategy as well on top of this. But the most basic strategy, I think, for the common man and the easiest one to follow with the least amount of time is just simply buying every 2 weeks. And we know from data that in the long run, you will have success, right? Because there hasn't been a time over, let's say, if you're saving for your retirement 10, 15, 20 years, you have almost a 100% odds of having more money with inflation adjusted than when you started. And usually the CAGRs, inflation adjusted, end up around 7 to 8%. So you're going to do pretty well if you stick to that strategy. And this is what I love about this book, is that it doesn't leave that opinion to chance. It makes an opinion and it uses actual data, right? Let me make this big here. It uses real data to make these assertions, right? You can see here where it has actual data so you can understand the strategies over time and how it performed. And it basically convinces you with these base rates, right? So in 3-year rolling period, I beat the market 72% of the time, right? Over a 7-year period, 84% of the time. Over a 10-year compound period, that was 96% of the time. This one here happens to be one where you're buying large stocks. So this is with high market cap. I believe it's over, 200 million, let's say, with high net operating cash flow. So this is just one factor of a million factors that you can buy companies on. And there's websites out there that will let you screen and do this and backtest. Maybe we'll leave that for another video. But I highly recommend that if you are investing, if you're someone who is investing, because I know the NFT space, there's not a lot of data-driven decisions. Usually it's just people saying, I think this is going to do well, I'm going to buy it for whatever reason. I believe in the team, right? But I think when it comes to things like this, with the big news of the stock market dipping, we should really have a conversation about and reflect, well, how do we invest in my case, NFT money is kind of fun money, but how about real retirement money in the future that I'm going to rely on? What am I doing with that? Am I throwing darts and picking stocks? Am I going with a FANG strategy? Am I taking a data-driven approach where if I'm following some kind of strategy that I have data telling me that over the long run, I should be okay when the market dips like it does today or last week, or even if we go into a recession, as long as you have a well-structured financial plan, then what are you worried about? Because you will be buying more. Crazy things can happen. People can lose their job. Bad things can happen. But if you are an investor and you are able to continuously bring in income, you should never abandon your strategy if you committed from day one that I'm following a strategy where I'm going to stay invested and I'm going to buy every 2 weeks, every month, every week, whatever that reoccurring amount is. If you stick to the plan, even these times, because you're going to be tempted. You're going to say, well, look, the market is dipping. I'm tempted to sell out and wait and time the market. The only problem with doing that is that you need a strategy to back it up. If you're going to use technical analysis, which works, make sure you use a strategy and you understand how often that strategy will have successful trades. I saw this amazing thing on Robinhood. We don't have Robinhood here in Canada with option trading, where it literally tells you your likelihood of success when you do these different option tradings. If you're going to do one of these rollover strategies, right, where you're going to go and you're going to do a put, and at the same time you're going to do a call to kind of lower your risk, and it actually tells you at the bottom your probability of success. You should be doing that with pretty much every investment approach. As much data as you can get, the more likelihood you will make a decision which is better. And this book basically concludes a couple things. So one thing is that you should use multiple strategies. There's no one strategy that will always be better than all the other strategies at all times in history. Many strategies can do very well long term. Some will perform better than others during certain time periods for various reasons. So for the best balance of risk, it's good to use multiple strategy approaches. This is one of the conclusions of this book. Another thing is multi-factor models. If you're a little bit of a quant like I am, you like using quantitative factors to make decisions. So multi-factor means don't just rely on one factor. For example, I am going to buy only stocks that this month had the best 6 months of price appreciation. That's a momentum strategy, which has had success over time. But if you can marry that as well with some factors, I don't know, that factor could be cash flow, right? You're gonna have to back test it. You're gonna have to explore. If you can marry it with some factors, you can do better than just a single factor. I'll give you an example. One he has here, right? He says all stocks. He said he's gonna buy the top 50 by 6 month momentum, and then he shows here your different percent of time that you beat the market. And then he has another one here where he says, okay, well, I'm gonna buy 6 month momentum, 3 month momentum, and 12 month momentum, and I'm gonna buy micro cap stocks. And then it gives me my base rates here on how this did. It actually has a 100% in 10 years, but in 1 year it has only a 78% of beating the market. So this is the power of data if used properly for decisions that are very, very fuzzy to make. It's very hard to predict the future with stocks. Everyone knows that past performance does not necessarily mean that future performance is guaranteed. With that being said, the stock market is not random, because when studied with these different factors, we do see that some stocks tend to perform better when they meet certain criteria than others. So if you insist on consistency, if you stick with strategies that you have dug deep on and you understand, you know your probability of success, if you stick with strategies that have proven to work over the long term and you ignore the short term, like today, I don't know what's going to happen. I don't know if the market's going to keep going down. I don't know if the market's going to keep going up. I don't know for sure if we're going to be in a recession or not. I don't know what's going to happen, but I know I have a strategy that no matter what happens, as long as I stick to my reoccurring dollar cost averaging, in my case, every 2 weeks, it could be every month, it could be every week, whatever you want, you stick to buying. In my case, that the one that I use is market ETFs. That is just a broad market between the global, Canadian, American, whatever, different global markets. I've back tested it on websites that allow me to back test it, and I know I have pretty good base rates in the long term. I have this book's data that tests 100 years of the stock market to back up that this will be successful in the long term. Let it dip, because if the stock market dips, I can continue to buy and stick to my strategy, and in the long run, it should outperform the prices that we see today, just like the prices 10 years ago have been outperformed than what they are now, just like the prices 20 years ago have been outperformed than they are now. So anyone who's done this over history has been rewarded because of their consistency and their dollar cost averaging approach. So this is just a video I want to put out there. I don't know if you guys, let me know if you guys enjoy this content. Maybe we can do more of it. There's a different side of Superstar Money, which we haven't really shown. We do love NFTs and NFT space, but with the news going off right now about the market, I just want to bring up something about me and my personal life that I do. If anyone's interested in learning more, it's called What Works on Wall Street. You guys can check this book out. Quite a read. It's I'm not gonna lie. If you gotta really like math, all right. If you're a numbers guy like me, maybe you won't mind it. But I'm telling you right now, if you could get through this book, it's very, very insightful on strategies, and it can maybe help you if you're walking in right now to the market, you're buying stuff, you're throwing darts, like, you know what, I just want to buy this stock because I think it's going to do well. Maybe you haven't had a lot of success. Maybe you'd be better off, reading books with strategies that give you consistent strategy that you can follow. So maybe you have a shot in long term with your approach. So this is just my opinion, guys. You guys obviously do what you want. This is my thoughts, but I'd love to hear your thoughts about what I just talked about right now. A lot of us in the NFT space are always thinking about the all-out approach, right? Like just going all-out home runs, explosion kind of thing. But you can't always go for that. Sometimes we got to look at other more consistent, boring approaches that have shown a lot of success to work over the long run. So if this video at all was valuable to you, if you learned anything from it, let me know in the comments below what you guys think. And before you go, if you haven't already, don't forget, become a superstar, smash the subscribe button, join the Superstar fam. Hit the bell notification to get every single video every single day. Also, Superstar VIPs, 2 months, start beside your name. Ask for special giveaway says, thank you so much. Take care. See you next one. Bye bye.